I want to know about real estate. Let me tell you about real estate. It sucks. Right now, to me, it does. Five cap. You can't get a goddamn 5 cap if I got to pay 6% interest rates. Party's over, sellers. If you didn't sell, you're stuck.
Today, folks, it's no surprise real estate investors are completely struggling. And as somebody who is investing, looking for monthly passive income from the real estate investment trust market here in Canada, there are a lot of things I'm paying attention to in this interest raising environment. As stock prices become suppressed, as interest rates go up, I want to tell you what I am paying attention to and what I'm looking to buy. But I'm also somebody who's looking to geo arbitrage their life, taking a look at the different markets where the standard of living is higher, where I can move to exponentially save more money to generate more passive income. If that is a conversation you can appreciate, hit that like button, folks, because this is utterly fascinating. Taking a look at rentals.ca before we dive down into some individual REITs and what I'm looking for specifically, the average rent for all property types across Canada in September 2022 was $2,043 per month, representing an annual increase of 15.4%. You know how insane that is, man? That's probably like one of the highest, rental raising periods we've seen literally in a decade. The average rent is up 4.3% monthly and 21.9% from the recent market low of $1,676 per month in April of 2021. The average rent is now about $100 more than the pre-pandemic level from the fall of 2019. And just taking a look, guys, this is a really good heat map to give you a good exemplifier of where the hottest, most heated markets are. No surprise, Toronto kind of just takes the cake here with Vancouver. I think those prices spread out across the rest of Canada, so the average is kind of hard to take without a grain of salt. But as somebody that wants the geo arbitrage, as somebody that's looking at real estate investment trust, this matters a lot from a few different angles. First, from geo arbitrage, if you don't know what that is, that's people who look for cheaper areas of living to build their businesses. As somebody that works from home, has a non-localized job, I don't know why I'm living near Toronto, the most expensive area pretty much in all of Canada next to Vancouver. Whereas we scroll down here after visiting different areas in Canada, guys, when you're taking a look at places like Calgary, Edmonton is another place that I'm looking at here. We can see Edmonton is down at the very bottom with a 2-bed, 2-bath apartment averaging about $1,362 a month, and a single bed about $1,000 a month. Scrolling back up, compared to Toronto, where the average 2-bed is worth $3,300 a month, Vancouver $3,700 a month, over double the asking of the rent in Edmonton right now, with the average 1-bed being around $2,500 a month. That is staggering, and I want to kind of take that information and go into Canadian Apartment Properties REIT. This is probably the exemplifier of what is going on, being Canada's largest apartment property real estate company, that should give us insight into how bad things are truly getting. So earnings are coming up for this company November 9th, and I want to show you what I'm paying attention to with the good and the bad side of this company, as it's currently yielding 3.35%, and I am looking at adding this to my portfolio, but cautiously, and let me explain why. First and foremost, the average monthly rent right now across their diverse portfolio in Canada is getting about $1,167 a month, which is like half as much as the current market demand. The reason that is each province will only allow you to increase rent on a tenant by usually a couple percentage points a year. But if that tenant moves out and they get a new tenant, they can get the market demand from that tenant. So this is a company that I'm sure wants to push out all their current tenants and get new tenants, because right now no one's buying real estate. The volume of real estate is dried up by 50%, and everyone's just kind of moved into the rental market, which is driving these prices up so dramatically. And we can see that's growing. This is going to be a great benefit to this company over time, as every aspect of their portfolio is pretty much seeing the net average monthly rent go up year over year. For example, here in Ontario, guys, going from last year around $1,400 to about $1,480 as it sits currently in this year. Quebec, guys, from $1,026 to $1,105 for 2022. You got British Columbia going from $1,419 to $1,492. This is going to be a really common occurrence, I think, as the quarters evolve, right? But that's not what I really want to focus on. I think that's going to be something that's going to cushion them from the interest raising environment. But what you really need to pay attention to is the interest rates themselves. And if we come into Cap Rate's last earnings, these are from the 6-month here, guys, coming into, I think, June or July. But taking a look at the average monthly interest rate and the average mortgage term, this is going to matter a lot. We can see, guys, in 2022, their current across the entire spectrum of their portfolio, that interest rate sits at 2.6%. That's very, very low, which again, over a 5.82-year term are all going to come up for renewals, which means, over 5 years, a lot can change. The interest rate could stay up, it could come back down. So they do have a little bit of cushioning, but this really screws them on new builds. Basically, if they want to go buy new properties, guys, they're going to have to take out new mortgages at the highest rate. So it's likely that if they have any development going on, we're going to continue to see those interest rates probably peter up over time as well. But hopefully the rental prices will cushion some of that blow. The other thing that you can really pay attention to here, guys, is just scrolling down. What we want to take a look at is the interest paid on mortgages. We can actually see that those mortgage payments have gone up from 32 million to 39 million this year. This is for, again, the second quarter of 2022 versus the second quarter of 2021. So they are petering up, affecting the cash flow, the cap rates, and why people like Ben Mallow were screaming at the beginning I shared with you in this video, right? So let's talk about Riocan. One of the REITs I currently hold, this is Canada's largest retail apartment property REIT, and it's currently paying 5.13%. They really adjusted their portfolio coming out of the March 2020 crash. They lowered their dividend, they're stacking cash, they're looking to get into growth vectors, so they do have some cushioning against the current interest raising environment, where we can actually see right now, their funds from operations, so the actual payout, the distribution you're getting is only 55% of the cash flows, so they can cushion some of the blow. Because against that average weighted contractual interest rate here, guys, currently in 2022, this third quarter, which they posted for earnings, unlike the other REITs, which we're still waiting on, is up to 3.22%, which is up from 2.92% last year. And again, a lot of this comes into new construction builds and a lot that's going on. So again, at least they have this locked in. I'm not seeing the term rate for how long those are locked in for, but those are things you're going to want to pay attention to. So let's talk about Smart Centers here, another really large retail REIT. Again, I love these. I currently hold Riocan and Smart Centers. This one's paying 6.69%, starting to rebound off its lows here. And let's just take a look at this one, guys, with the weighted average interest rate being around 3.3%, falling in line with Riocan. Seems to be a pretty prominent thing within the retail sector. And the average term for these are 4.4 years. So again, we do have some cushioning to let the interest rates perhaps rise up pretty dramatically. It gives it a couple years to perhaps let the Fed or the Treasury lower the interest rates. It's kind of speculative, so I don't want to play it off the interest raising environment. But that, again, at the bottom line is going to affect that cash flow, which could affect the distributions if this company isn't well managed on its current mortgages. But in other news, guys, Granite Real Estate's earnings are coming up, and this thing has been bumping up dramatically today. And I want to explain to you why. This sector is very interesting because it's crashed so dramatically. And again, this has a lot to do with shipping, warehousing, Amazon type logistics centers. And I know they're going to get hit to some degree on the growth side of it because these companies were so growth focused that I think they're going to have issues getting new growth at decent cap rates because of the interest rates, right? Again, Ben Mallow all over again. But take a look, because we're getting 4%, but this isn't the only REIT that's blowing up. Dream Industrial, guys, this one on the one day also jumped up 4.14%, and it's all driven on the back of Summit Industrial REIT. These industrial REITs just did so well for so long, but this guy exploded today. It jumped up 28%. This is probably one of the biggest pops we've seen in the real estate market since the beginning of the year. And what's driving this? Well, apparently Summit Industrial, guys, the income REIT, enters into an agreement to be acquired by GIC, which is a sovereign wealth fund, I think in Singapore, in partnership with Dream Industrial REIT in a $5.9 billion transaction. It turns out that Summit's being purchased for $23.50 a share, and this is some pretty big news. I'm really curious because they don't mention enough in the articles, and I don't have to dig around because most of this seems to be for the sovereign wealth fund and less for Dream Industrial, because I really thought Dream would have jumped up a lot more if they're getting some part ownership in this. But this is what's going on in the suppressed market. Most of these REITs right now are trading well below their NAV, their net asset value. So nonetheless, I am just taking a look at Granite, I'm taking a look at Cap REIT, Canadian Apartment Properties, and I'm also taking a look at Northwest Health Properties. I'm not the biggest fan of this REIT because I'm having a harder time wrapping my head around their global diversification. It's a lot more harder to understand, very similar to MPW in the US, but pays a whopping 7.25% yield, and is something that's worth putting on the list because it does have a long-standing history of being public if you are looking for those monthly distributions. So tell me what you think in that comment section below about your favorite real estate investment trust. I'd love to hear about it. So stay cool, stay awesome, and as always, I'll catch you in the next one.